Hello, good evening, guys. My name is Crypto Kiban. I want to discuss briefly on invalidation levels, risk tolerance, and stop placement. I have discussed about this in my risk management video and market structure video, but then there are still some confusions, so I would like to clarify a little bit on them in this particular video. I hope this video will be helpful in understanding the missing points from the past videos. So how we start with invalidation level. And when we talk about invalidation level, what does it exactly mean by saying a trade is invalidated? And I used to say, wherever we are placing our stop, we want to make sure it is at a point of invalidation. That is a point at which we accept that we are wrong in the market, or our directional bias is wrong, or the decision to long is wrong, or if it is too short, it's wrong. And then we get stopped out from the market from accumulating more losses. So how do we identify a point of invalidation? This we have to do a bit with market structure. And like I said in the market structure lesson, we have a series of higher highs and lower highs. Assuming we have price moving in this direction, when looking at earlier waves, this will be a complete wave because earlier waves happens with 3 impulse waves and 2 correctional waves, and which is 0 to 1, 2, 3, 4, 5, making a total of making a total of 5 waves. And it doesn't go up in one straight line. This impulse wave of 0 to 1 also has a mini or a small waves of 5 sub waves like this, or as let me just, which comes like this. So here we have 1, 2, 3, 4, 5. So that makes this wave 1 of a bigger wave, and the correctional wave doesn't come in a straight line either. It comes like this, A, B, C. So that makes the correctional wave 2. Then the impulse wave 3 is another 5 waves, maybe smaller waves, 1, 2, 3, 4, 5, like that. Then we have another correctional wave of A, B, and C. The same thing for the 5th leg. And at the end of the day, when this bigger wave is completed, it then becomes another big wave of, this will then be 1 to 2. Then we have a correction of the correctional waves 2, then 3, 4, 5, and thereabout. So you should take note of these wave counts. It's very, very essential to note these wave counts because they will help us in identifying when a market is due for correction or when a market is invalidating our trades. So back to the market structure. So assuming you come onto a chart and you see a structure like this, and then maybe on another chart and then you see a structure like this. What does this mean? Remember, this may be 5 smaller waves and this will be 3 smaller waves, so it doesn't matter at this particular moment, but you are seeing a low, an high, an higher low, an higher high. That is 1, 2, 3, not completed yet on one big waves. Then you have another chart, whereas you have 1, 2, 3, 4, 5. So when you get to this chart, when you see these 2 charts, what will you naturally expect? For this to make an higher high, it definitely implies that you want a retracement of the market down to a higher level to make an higher low, either at this point where old resistance will become support, or at a little lower price line, but you just wanted to make an higher low than this very low. So it makes an higher low, then you expect it to make an higher high to complete the fifth wave like this. So assuming you come to the market and you see this on your chart, your expectation is for it to come down, pull back, a correction, right, in ABC or maybe straight higher times, then make an higher high. So where will you naturally want to enter the market? If you trade support and resistance, you probably want to enter at this old resistance turning support. And if you trade supply and demand, you probably want to enter any point at below and above this very low. So as a support and resistance trader, your expectation will be for the market to come into it like this and make an higher high. Whereas as a supply and demand trader, your expectation, or Fibonacci trader, will come into this zone and then go back to make an higher high. So this will be your trade setup. Now, where for this particular trade, where will be your invalidation level? I have said many times that when price makes an higher low leading to an higher high, that very last low leading to an higher high is the point we want to see if it's taken out or not. The moment this low is taken out, then I will take it that the market is reversing, right? So that will be our invalidation level for this particular trade. That is why you sometimes see support and resistance trader when a resistance is broken, turning to support, and they are entering at this level, they place their stop loss below these very lows. Some do place their stop loss here, risky, but whatever works for them. But many also place their stop below the low, breaking the old resistance. So they enter here, they place stops here. Supply and demand too, we enter here and place stop below these very lows. Because they expect price to come. Some will expect price to even make a double bottom with this very low and go back higher. So this last low leading to the higher high will be your invalidation level. And why is that? Assuming price comes like this into this demand zone, then makes a what's it called, a lower high, and then breaks down like this. This is not the low to break because it didn't lead to an higher high. For all we know, we could have something like A, B, C. It will just retest it and be a truncated retest of this demand zone. Then for price to start 1, 2, 3, 4, 5 to make an higher high to this. So once I see a formation like this, when price come into any area, makes a lower high, then it's coming back, I won't, if this low is broken, at times it will happen like this. At times it won't even come into the demand, but then it will come into the demand here. Some people will, because this low is broken, they will say the trade is, the direction of the trade is changing. But no, I will hold this low until this very low breaks before my bias break or my bias changes. That is why on my last analysis on Bitcoin, I didn't change my bias until the 28k level is broken. And what do we have today? So sometimes you have it coming into demand, making a lower high, then coming to break these lows. What is this exactly? When we look at this pattern, this is head and shoulder. We have the left shoulder here, we have the left shoulder, we have the head, and then we have the right shoulder. So the moment this low breaks, some people will even draw the lows like this. When they say it like this, they will draw it like this, those trading patterns. And then we call it the neckline. So the moment it breaks to the downside, they are waiting for a retest of it and continuation further down. That means the moment this very low breaks, is giving you an head and shoulder pattern already. That means your bias has changed from long. You are no longer looking for long. If you are looking for long at a price level, maybe from around there, it means you are basically looking for a long, not on a long time to go to an higher high now, but where price will come to, then go back to make that retest of the lows broken and then come further down. So whatever long you take when your invalidation level has been taken out is a short term long or little time long, just to make a retest that this low is completely broken. So that will be the invalidation level for this chart when you see a non-completed formation like this. Then this is another thing entirely. Now, what do we expect from this other chart? Assuming you come to the chart and you have 5 waves completed like this. Like I said, 1, 2, 3, 4, 5 waves, the waves and the length waves. So these waves will become just one big wave. One big wave like this. 1. Then you expect a correction for 2, then 3. That will be on a much bigger waves, right? So what are you expecting the moment you see this? You want to take this as a subwave of another big wave 1. That means you are no longer expecting a little correction from this top to make to make an higher low and then continue to make an higher high. Of course, it can happen at times. Some trends are overextended. But most times, when you see 5 waves like this, 1, 2, 3, 4, 5, what is expected is the correction. You should take this whole trade as 1. Then you should expect it to correct as 1, which means you should expect at least minimum of 50% move of this movement from these very lows to these very highs. So if you are placing a demand level at this point, if you are seeing a demand level at this point, or as a support and resistance, you are seeing a resistance turning to support at this point, it may not work. It may not work because the market dynamics is correcting on the total waves. This has corrected maybe 50%, this has corrected 50%. Then even if this particular waves correct 50% like this, let me use the ABC2. If it corrects 50% like this, that will be an A. Then you want it to make a lower high and then a bigger correction, which means if you have a support and resistance, it may break, it might hold for A, and then this demand too can also hold. Price may just come to this demand for the last correction. It depends. But then, like I do expect, I want the movement to make at least 50% on the Fibonacci retracement for it, because we are not treating this as 1. Then we expect a 2, and 2 waves should make at least minimum of 50% on the retracement. And looking at this particular drawing, we can see the 50%. We have drawn a little demand zone at that very point. So you might have ABC like this, and it gets here only to go back up. So this will be a different scenario to the first chart, because this will be the 50%, and also you can have it like this. This might be your A, then B we use here as it will break down, then use it as resistance again, only for it to come into the 78% or even close to the 100. So it can come like this. So if it happens like this, what are we seeing again? Here we are seeing the same head and shoulder patterns, right? We are seeing the left shoulder, we are seeing the head, and we are seeing the right shoulder. And the moment this low breaks, people believe it will come back into it and go further down. But then we know that we are trading this one as one big wave, and we are making a correctional wave. And this then will become our invalidation level. The very low, because this is our 1, we expect 2 to make an higher low, which is higher than this particular lows where the movement originated from. So in as much as this low is intact, then we want anything below this low is invalidation level. So how can you trade supply and demand or support and resistance when you already have the 5 waves completed like this, and you know reversals can come into anywhere from the 50% range down to 78, even down to the 100, but you don't want to see it below the 100, because below the 100 is telling you that the dynamics has changed. If you then combine this particular chart on a much bigger time frame, assuming this is on the 4 hour, if you look at it on a daily, it will show you maybe just one move, or maybe just 1, 2, 3, or one big move. Then the moment this leading to an higher high is broken, then you know the trend is reversing. Are you getting the point? So this will be our invalidation level. Remember, here, this particular low was our invalidation level because the movement, the 5 waves have not yet been completed. But here where we have the 5 waves, we are treating the full movement 1, 2, 3, 4, 5 as one big wave 1. Then we expect another big wave 2. We may have an on coming on the big wave too. It's not that we won't have 1, 2, 3, 4, 5 coming down, then 1, 2, 3, then 1, 2, 3, 4, 5. We will definitely have it. So whatever demands are here are playing out, but they are giving you little gains. They are not giving you that much more gains like 10 hour, 15 hour, like that. They may give you 2 hour, 1 hour, 3 hour at times, but they are coming down to make the test to find a bottom for this big range. And then once that is done, you start seeing it breaking all levels of supply or resistance and then going up and making an higher high to this very high at the end of the day. So here will be your invalidation level when you have a big waves like this and you're expecting a big correction. So if you want to take trades on this, assuming you have a demand zone here, you have another demand zone here, you have another demand zone here. So you have demand zone here because this led to an higher high. You have another one because it led to an higher high. Then you have your big demand here, somewhere around like this. And below this low means the bias has changed. So how can you trade this and use your invalidation level, like I said, which is here, as with your stop loss? So this is where we go into risk tolerance. Risk tolerance is not the risk, it's not the movement on the price chart. The price, you know, somebody's loss is somebody's win. This game is a zero-sum game. For there to be a loser, there must be a winner. If you take a trade at this point and then it goes against you, then you sell to stop loss. Selling to stop loss means somebody is buying from you and that person is probably winning you. It's a competition. So for you to lose in that game, the money you have lost, you put another $100 on this trade, then you exit here and you come out with $50. That $50 that you have lost is profit to somebody. Either the person shorted the market or the person bought from you at that low price. So the movement, if you are buying here and you are placing stop here and you are afraid that you may be stop hunted, the movement is not the movement in price, is not your risk tolerance. Your risk tolerance is the amount from your capital you are able to tolerate and lose to the market in case you are wrong. Like I said in this example, we have 5 waves here. This demand may hold and it may not hold. It may hold for A, B, C, but then you may be expecting it to hold and lead to another high, which the market is not ready to do. So if you are not able to study the market, to follow whatever the market is giving you or is showing you, you may be caught on the wrong side. So assuming you are buying here and you expect the market to make an higher high to this, but the market is correcting for these big waves and it's coming to the 78% level, it won't do that. It will just give you maybe a little bit of profit, which you may not take, and then it will come back to break this zone. But you have your stop here at this invalidation level that you may see, but which is not necessarily the invalidation level because we are correcting on a big time frame or on a big structure. So how do you trade this trade? You may want to take care because you may be expecting, okay, sometimes market will come and go back in some really parabolic market. Yes, then that is where you want to scale in your entries. Here is your invalidation level. Below this price line, you are wrong. So below this low is where your price stop loss should be. This is where your price stop loss should be, or your trade stop loss. If you want to know why the market do on stop loss, it would be good if you watch the smart money video. I explained that one in detail on the smart money video. But if you want to take this trade, you want to trade at all these demand zone, you can take each trade as one, as in each trade on its own, because some people trade level to level. So you trade here, you place your stop below, but where you are placing your stop, are people also buying there? Okay, look at this. You have these eyes, you have this eye here. Don't forget that support and resistance people are looking at this eye as resistance broken, turning to support. Now it has come back here probably and need us support. They are also believing that anywhere between this range, price may come into it another support. So you may be buying maybe just a bit above here and placing your stop here, but then support and resistance people are waiting below there, especially people who believe the market may play an aunt. Because in crypto we do see a lot of wicks, it will wick down then close back above. So you want to be conscious of that people, or maybe on another time frame, where you are placing your stop is not where some people are really buying. Then, but if you still want to take this trade, then that is why scaling entries or laddering entries is good. You may choose to buy at this point, then choose to buy at this point, and then choose to buy at this point. And that is where your risk management should come into place. Now, you want to have your stop loss here, but then you want to buy at this point. Then you should be able to calculate the position size. Assuming you want to place 1,000 or less than $900 into this trade. That means you'll be buying 300 here, 300 here, and 300 here. Then you will have an average entry. When you calculate it, you should have an average entry. The average entry from this particular area to your stop loss in distance now is what will give you the position size that you will trade. I'm not sure if you are getting me. Let me deploy my tool once more. Okay, this is it. Assuming we have this trade, I want to calculate my position size, right? Assuming we have $650 as a balance, then I want to risk, let's say 5% of my account balance using 20x leverage. Then how do I go about this? Assuming this is my first entry, I know I'm entering equal amount on each trade. That means I'm not entering maybe 200 there, 300 there, 500 there. I want to enter with the same amount on the 3 trades. So that is where these two also come in handy for me. So what price am I entering the first one? 1250. 1250. Oh, sorry. 1250. I just use the amount as $1. Then I have another $1 here, then $1 here. Then where is my second entry? 1214. And then where is my third entry? 1191. Let me change this to 100. Okay, equal amounts. So then where will be my average price? My average entry price will be 1250. Let's mark this differently. 1250. Something seems broken on my calculator. I think I will have to. I modified it recently, but it seems I have missed something. This shouldn't be so. This shouldn't give me 1250 as a price. So let's do this manually to calculate. Since we are entering at the same, at a static point. So if we enter 100 here, and then we enter 100 here, that is 50-50. Then the price line, the entry price will shift from to this point. Then if this letter gets filled, then we have our entry price at this 1212 level. So let's mark that 1211. Okay, then your position, to calculate your position size, and you want to calculate the distance from this point to where you place your stop loss, which is this very point, and that is 4 point something percent, 4.2%. So let's do it on the calculator to calculate what our position size will be. All right, so we have 650, we are risking all this. Then our entry price, average entry, once price come and take you in here, takes you in here, takes you in here, and then it's reversing, your average price is this. So that is 1211, right? So average price, entry price would then be 12.11. Then where is the stop price? That's 11.60, right? Stop price is 11.60. Then where will you expect to take profit? Because this is a big correction on this big wave, you expect price to make an higher high. And so if we check where price is supposed to go from this particular level, when we have a correction from here to here, and assuming price got to this very low and then reverse, then we expect at least 1.272 or 1.618 level. So here or here will be your take profit, but your first take profit will be these very highs. Now checking for risk reward, let's check for the risk reward and see if this will be rewarding. So this is what we want to do. This will be our average entry. This will be our stop loss, and where is our take profit. The first target is here, right? And that alone is giving us 2 hour already. And then the main target, the second target is here, which is giving us 3 hour. So if we are going for 3 hour, then 1,364 will be our take profit. So let's put that in 1,360, right? Yeah, 1,364. Okay, 1,360 is also okay. So here already we have 2.9. If I input 1,364, probably we have 3R. Exactly. So now here is showing us 3R. So what is our position size here? Position size is showing $771. And how much are we losing if this trade should go against us? This is a trade, right? And this is a risk amount, $32.5, because that is 5% of the account balance. If you are risking 1% of your account balance, then you see, if this trade goes against you, you will lose $6.5. If you are risking 2%, then you'll be risking $13. So that is it. So because you are risking an amount between here, and the stop distance to stop is 4.1%. That is almost 5%. Then from your entry to your 3R will be around 15%, 12% something. Are you seeing it now? So your risk tolerance is not the movement in price. That is the trade tolerance. If you are able to tolerate the trade to move from this very point up to this point, that is not your risk tolerance. Your risk tolerance is the amount you wish to lose in case the market goes against you. Some people, they may even enter from here and place their stop below here. They won't scale in entry at all, and that makes it easier. So if they are doing that, they are entering here, and then they have their stop below here, because they believe market can come all the way into all these areas and then reverse. But they want to buy early, so they are entering here, assuming they are forcing a double bottom here or a support. Then they want to enter the trade here, but they want to play their stop below here. They also recognize that this is a big wave, and probably this is a 50% level. Fibonacci traders, they do that a lot. When they slap their fib to like this, and they choose to enter anywhere, and this one, where is their stop? Their stop is always below the 100% level. So in such case, some people will enter here and decide to put their stop here. If you want to raise 2% of your account balance, which is maybe $6 or $13, and the distance to stop here is 6.1%, 6.5. So let's see if there is any difference in risk taking. So here we have the entry price as 12.41, right? Here will be 12.41. And then where is the stop price? The same stop price is still 11.60. Forget their take profit for now. It doesn't matter if it's 3R or not. But we are looking at the amount to lose. And then the risk amount here is $13, because we are risking 2% of the balance. If you were to be risking maybe 10% of your balance now, then as you are risking 10% of your balance, you are risking $65. If you risk 1%, you are risking $6.5. If you risk 3%, you are risking $19. If you risk 5%, you are risking $32. No matter the distance If it's either year or year, the amount you can tolerate yourself to lose is the amount you will lose. Even if you enter this particular top, maybe you FOMO day and you expect price to go up, but if your position size is well calculated, even to this distance, the same amount is what you will still lose. Now let's take a virtual example here. These were trades that are called on the week. These two I call this one, I call this one. So now let's look at this. We have these two trades, right? And we have different sizes for them. Let's check the size and see. This trade we have from this top to this bottom, right? And that is a 5.63 distance from entry to stop. And then this second one we have from this top. This is a daily zone though, but we'll be able to get the insight there. And the entry to stop is 15.5%. Assuming you were to be taking this trade, how much do you think you'll be losing on this particular trades? Assuming you have $1,000 as your balance, let's change that to $1,000, and then you want to risk, let's say 5% of your balance, right? You know, it doesn't matter, it will still be the same thing at the end of the day. But let's just assume you have $1,000 and you want to risk 5% of the $1,000 in case when you are taking out, you lose just 5% of your balance. And if you win, instead of, you know, going for 3R, that means you are winning 15%. That's the risk, the amount you have to lose here, you will win it in 3 folds. So let's calculate. The position size will definitely be different. This will be smaller and this will be bigger. Now let's see. So here, the first one we have the entry as 1267, right? The balance is $1,000, risking 5%, 20 years or 5 years, it doesn't matter. Okay, let me just do this. Let me do test 2, then test 3, 1,000 on all. Here you are risking, okay, let's say 5% or true. But here you are using 20 years, here you are using 10 years, here you are using 5 years. And then you have 1241 as entry, right? For this particular one. Okay, 1268, 1268, 1268. Then yes, from 1268. Then the stop loss is 1160, no, 1191. Okay, then the stop is 1191. All true. Okay, let's fix the let's say 1,005 for the take profit for all three. Okay, now look at this. On the 3 trades, we are here now. I'm showing you difference in leverage. Here we are risking 50 all true. Now the coin amount we are buying is the same. The position size is the same on all 3. The margin is the difference. Now where you have lower leverage, your margin is big, you have higher margin. But where you have higher leverage, you have lower margin. That is what leverage does. Leverage just increases your margin or reduces your margin. Now let's now check with this particular trade. This entry is 1087, right? You are risking 5%, 1087 as the entry. Then where is the stop for this? 915. Okay, let's leave the take profit as the same thing. So these 2 trades, this one and this very one. Now the risk amount is the same, $50, right? Now see, The difference to stop for the first trade is 6%, while the second one is 15%. Now see, here the position size is different. On the first trade, with the smaller, on the first trade, this very trade, we have position size to be $823, whereas this big one, we have it to just be $315. But the risk, the amount we lose on this trade or on this trade is the same. It's the same $50. It doesn't change your risk tolerance. Your risk tolerance is the $50. It is not the distance from your entry to your stop that is the tolerance. No, it is the amount you can tolerate yourself to lose. But then you can risk, even if you have a tighter stop, assuming you are taking a trade here and then your stop loss is very tight, like 1243. Assuming your stop loss is very tight, see the position size 2,536. What this means is the amount of money that we lose $50 from year to year under 5.6 something percent is bigger than the amount of money that we lose the same amount on this bigger movement. So that is just the difference. That is the difference. It is not the distance from your entry to your stop loss that is the risk tolerance you are taking. No. That in fact is a trade, because you do not know, is the probability, you do not know where the market will reach and then choose to reverse in your favor. But then you are saying, if this market gets to this point, you can no longer tolerate losing. Assuming you have calculated your position size with this particular trade and you are trading $800 and something here, whereas your stop is supposed to be here, but you refuse to use stop. The moment the trade starts coming here, you start losing more than what you should have lost. At this point, your loss will be $50. Then if the market goes 2% against you more, like here, that means you are losing additional $25. Then if it goes another 5.6 something, at this point you are losing $100, because the position size you have taken is big. So the bigger the move, the bigger the loss. So but on this fixed move, the amount to be lost is just $50. That is why the amount of position size here is smaller. And when you are trading with a small amount, okay, here your 3R will be almost 45%, whereas your 3R here will be just almost 15% or 17%, thereabout. That means if you are trading that $300 that you are trading here, you know, for you to make $150 on $300, that's like 50% of the move, right? Of the 50% of your position size. So it will take a lot of move, and that is why you see you need like almost 45% move in favor before you can make that 150. But here you are trading with $800 on a 5% stop. That means $800, if you calculate it, $800 plus 15%. That will definitely give you more than $150, which is a 3R in case you make a 3R profit. I don't know if you are understanding, or maybe it's a little bit confusing, but that is the difference between risk tolerance and distance to stop. Distance to stop is just showing you that, okay, if you can tolerate price movement or invalidation level. Looking at this chart, if you're asking where will the invalidation be for this particular chart, this particular chart is, okay, we have, assuming we have this very low to this side, is this move up to 50% of this entire move? If this move here is up to 50% of this entire move, then that will be 1, 2. And now we have an higher high. Even in earlier 12, we say the third wave should not be the shortest. That means you want it to be longer than this very one. But nonetheless, market structure, we have an higher high to this. So this low is the low to break. and here will be your invalidation level. We have a low here, which definitely this is clearly more than 50% of this move here. Then we have an higher high. Is this low now a new low to break? This particular low here. Is this now the new low to break? As in, if price comes to invalidate it, that means that we are not bearish? Of course, even though we have an SFP here, where market chooses to run the highs but close below it and tries multiple times but failed, and people shorted the market into this demand, which is now attempting to break it again. Now we have this low to this side, to this higher low, to this higher high. Nonetheless, it is an higher high. Now we also have an higher low, which is keeping the structure in shape, right? This was the old invalidation level. Now this is the new invalidation level. If you draw your trend line to like that, you can see it's respecting it. So this is the invalidation levels at this moment. The moment this highs or this particular movement makes an high higher than this particular high here, higher than this particular high, then this low here will become your invalidation level. The moment price closes below it, then you want to start looking for short. Assuming we have this movement coming to make an higher high like this, then maybe making a lower high like this. What will you notice from this place? It's simply more or less a double top like we have here. We also have a double top here, but this is the neckline. Price didn't get there because also we have an higher high. Then the moment this low breaks, you expect price to come make a retest. You want price to make a retest. You want price to make a retest and then go lower. That is what will be the expectation. But as price is currently is that we don't see an higher high to this already. We are also making a lower high. Probably this will break the highs. The moment this low breaks, then it's danger. But then look at it, this low is quite inside the demand zone. And as it is expected, anywhere from this range of this demand is expected to hold. So you can see, say, you won't look at this low, but then you will look at this very low the moment this low breaks. Because those who trade supply and demand, they will be buying all through this box and now they are stopped below. They won't consider this low. But then if they didn't make an higher, choose to retrace, yes, you can see buy here, even not minding the hem pattern that is printing. But then the moment again it tries to go up but fails, then you know this demand may break. So that is how you can identify invalidation level. And if you are taking a trade, assuming you are taking this particular demand zone on this level, this particular demand zone that is holding, assuming you are taking a trade on it, then where will you have your stop loss? Will you have your stop loss here? Or will you choose to buy here and have your stop loss here? Remember, this is currently the invalidation level, but the invalidation level sits inside a demand zone. So for it to sit inside a demand zone means you're also looking for buys here. So you cannot place your stop below this invalidation level because you will be selling where people are buying. So your stop loss will rather go here. You can choose to take this trade. If it stops you out, fine. Then you'll be looking to enter here. But sometimes the market will stop you out of here. It won't quite reach here, only to return. So you can just ladder your entries. Buy here, buy at this point, then buy here, even buy in the middle of this, then put your stop loss here. So you calculate where is the average price line. If it's here, you check the distance to the stop, then you use it to calculate your position size, and then you check where your take profit is. Are there any speed bumps on the way to your take profit? If they are, then you know you might want to leave the trade if it's not going to reward you with at least 1 to 3 hours. So, and this is a daily chart for ETH. We have this size, we have this lows, this is the higher high to this, then we have this lows, then we have this new highs, which couldn't quite go higher. It closed below these very highs. And that is SFP, like I said, swing failure pattern. And then people shorted. But then there was a demand there, like I highlighted on the 4-hour, which is responding to price now. Price seems will likely close bullish today. And if it does, we expect a raid of this side and a close above. If there is a close above, then this low becomes your new invalidation low. But then for the fact that there is a demand zone there, means you just want to put your stop loss below the demand. And if you look at this wouldn't work on earlier 12. But then you can still count. Some people can still count for you. Some people can take this as 1, 2, 3, 4, 5. I'll say A, B, C. I expect the trade to come here. So this thing is not complicated, but it is complicated. You just have to study the structure of the market. And if you trade level to level, then just place your stop loss at a much distance where in case if you are to be stop hunted, you wouldn't be affected. Like this trade, this is typical stop hunt on this trade. Here, this is a stop hunt on this side, stop hunt on this side, where we have the price coming above it and then closing below it. Breakout traders will be placing their entry at this particular highs here, and it's likely they filled and then price comes back to close inside, taking their stop loss. So that is it. I do not know. Probably this is not the best explanation I could have given. I didn't prepare for it that much, so there might have been some mix up or some out of, But if there is any question or whatever you do not understand, kindly let me know. Then we go over it again. Thank you.